Well, good morning, everyone. My name is James Neal, and on behalf of the AFB, I'd like to thank you for joining us today. I'm joined by Mark Spencer, who leads the accounting advisory practice at BDO, who's going to take us through some of the many IFRS 9 considerations around COVID-19. However, the first thing I want to say is that from all of the AFB and BDO, we hope you and your respective teams, families and loved ones are safe and keeping well during the current situation. Before I hand over to Mark, there's just a few housekeeping points to go over. Today's webinar is going to be recorded, and we will circulate the slides and recording later. Your lines will be automatically muted throughout the webinar. If you have any questions, please submit these to the panel throughout the session using the Q&A box, which is on the bottom right-hand side. And please make sure that you use the Q&A box rather than the chat function. Feel free to ask questions as we go through the webinar, and Mark will try to cover these as we proceed or otherwise at the end of the session. Finally, if you're having any problems with the sound, please let us know also via the Q&A box. So, over to you, Mark.
Thank you very much, James. And good morning, everybody. My name is Mark Spencer, and I lead our Financial Services Accounting Advisory practice at BDO. And first of all, thank you from me for joining us today for this webinar. I hope that you find it useful. Financial Services Accounting Advisory at BDO spans all aspects of accounting and financial reporting across 5 pillars, with these being accounting change, structuring advice, financial instruments accounting and reporting, climate and corporate reporting, and all other aspects of accounting. One thing that the Financial Services Accounting Advisory team at BDO has been doing since the unfortunate onset of COVID-19 is engaging with financial reporting and prudential regulators in the UK and the EU, trade bodies such as the Association of Foreign Banks, our peers both locally and internationally, and other parts of the wider community on the application of IFRS 9 under COVID-19. In terms of agenda for the time that we have today, I'll be providing some context on the impact of COVID-19 in terms of accounting and financial reporting generally. We will then focus on some general considerations that relate to applying IFRS 9 under COVID-19, and we will also look at the PRA's Dear CEO letter that was circulated and issued on the 26th of March earlier this year. The European Banking Authority, European Central Bank, and the European Securities and Markets Authority have made pronouncements similar to that of the PRA, and they are largely consistent with what the PRA has been communicating to the market. And I say this as I'm conscious that there are a number of people on the call who have operations on mainland Europe. My understanding as well is that regulators around the world are making similar pronouncements globally. In terms of context, COVID-19 has unfortunately had an adverse impact on a large number of the world's economies. This will impact financial institutions differently in different jurisdictions, depending on, for example, the location of their borrowers and the sectors that they operate in, with such impact being reflected in the financial statements. This requires the distinguishing between what is to be reflected in the financial statements in terms of recognition and measurement and what is considered to be a post-balance sheet event. The consensus is that this is typically a post-balance sheet event for 31st December 2019 year-end, given the World Health Organization announced that COVID-19 was a global health emergency on the 30th of January 2020. I say typically because those entities that had closer links to the Wuhan province in China in terms of their exposures, their supply chain, and general business, then it may be a case that it was an adjusting event for 31st December, for those 31st December 2019 year ends. If it's a non-adjusting event, this means that detailed disclosure is warranted in financial statements, and this considered as part of going concern assessment in those 31st December 2019 financial statements. But this does not directly impact the numbers reported in the primary financial statements and disclosure notes. Consideration needs to be given to the recognition and measurement of the impact of COVID-19 for periods ending on or after 31st January 2020. And I mean, we will be taking pauses throughout this webinar, and now this is the first pause whereby, James, I'd just like to check in whether we have any questions today.
Yes, thanks, Mark. Yeah, we've had a question which is, we've heard a lot of talk of modified audit reports for the 31st of December 2019 in light of going concern, but you have said it's a post-balance sheet event for such year ends. So why are audit reports being modified?
Thank you, James, and that's a very good question. I'm glad that it's been asked now. This is because the going concern of the entity is assessed for at least 12 months from the date of signing the financial statements. So if a set of financial statements is signed on the 31st of May 2020, then going concern will need to be assessed till at least the 31st of May 2021, and COVID-19 is unfortunately going to feature substantially in those time horizons. Events occurring during the time horizon are not non-adjusting events for the purpose of assessing going concern. That is because material events happening within those 12 months would always be considered in your going concern assessment. Auditors have reporting requirements if there are material uncertainties associated with going concern, even when these material uncertainties are disclosed by management to the required level of detail in the financial statements. Modified audit reports are going to be considered the new normal for a while, and the market is being asked by regulators to get used to this. This is not a qualification of the audit report, so long as the disclosures are sufficient. We will now turn our attention to IFRS 9. First of all things being equal, there is an expectation that expected credit losses will increase. This is due to either the risk of the borrower defaulting increasing and/or the amount the lender would recover under any credit risk mitigation strategy decreasing. With this being true for any credit risk mitigation strategy, that is, putting the loan into recovery and working it out to maximize the cash flows that are realized, repossess and sell the collateral, if there is collateral, or sell the loan itself. IFRS 9's general approach to impairment, which applies to loans advanced, loan commitments, and financial guarantee contracts, require 12-month expected credit losses to be estimated for those credit risk exposures that are in stage 1, with the 12-month probability of default that is applied to these being more suspect to increased volatility given the increased uncertainty. Remember, under IFRS 9, the minimum time horizon over which you recognize expected credit losses is 12 months. You must at least recognize a 12-month expected credit loss. COVID-19 may trigger a significant increase in credit risk that results in the credit risk exposure moving from stage 1 to stage 2, meaning that lifetime ECL will need to be estimated when that happens. Expected credit losses also applies to financial guarantee contracts, and I understand that a large number of members of the Association of Foreign Banks issue such financial guarantee contracts. These are contracts under which the issuer makes specified payments to reimburse the holder for a loss because a specified debtor fails to make payments when due to the holder. And COVID-19 may impact both third-party financial guarantee contracts, such as letters of credit and bank guarantees, and also related party financial guarantee contracts, such as cross guarantees between a parent and subsidiaries or between subsidiaries. This is in light of the increased likelihood of the specified debtor failing to fulfill its repayment obligations. And what I have just said applies to financial guarantee contracts that fall within IFRS 9 scope. There are also increased instances of borrowers requesting lenders to modify the terms of a loan's contract, which can take various forms. For example, reduced interest rates, payment holidays, and covenant waivers. We will touch on covenant waivers later in this presentation, and we will also be talking about reduced interest rates and payment holidays as well. IFRS 9, though, has specific requirements for modifications, whereby this may need to be assessed in both qualitative and quantitative terms as to whether the financial instrument is a new one or a modified one. It is envisaged that a fair number of contractual modifications will not be to the extent that the original financial instrument is derecognized and the new financial instrument is recognized. This is given the nature of the contractual modifications to loan agreements that are arising as a result of COVID-19. It is to be said, though, that losses are still expected to arise in the lender's financial statements when the contractual terms of financial assets are modified, as the modified carrying amount is likely to be lower than the original carrying amount. And we say this because of the deferring of cash flows in the future, means that when they're discounted back to present value, that present value is going to be less. And also if interest rates are reduced, then that would decrease the amount that the entity will be receiving on a go-forward basis. And this loss is recognized in profit or loss. There needs to be a distinguishment between deferring and suspending interest, given the implications thereof in terms of repayment. And as I said, these are the modification considerations that relate to such actions that a lender may take. We will be talking about the impact of these modifications on significant increase in credit risk and impairment later on in this presentation. One quick point on hedge accounting, particularly cash flow hedge accounting. Forecast transactions under a cash flow hedge may no longer be highly probable, which would give rise to increased ineffectiveness, or may not be probable, which would give rise to hedge discontinuance and recycling of the cash flow hedge reserve. And this point applies under both IFRS 9 and IAS 39, because please remember, you can still apply IAS 39 hedge accounting under IFRS 9 until the ISB finishes the dynamic risk management project. And at this point, I'll just check in with James to see if we have any more questions from the audience.
Yeah, thanks, Mark. I think if I were to summarise the question, really, it's you've mentioned cash flow hedge accounting. Is there any impact on fair value hedge accounting?
Sure, thanks, James. If we think about it, cash flow hedge accounting, in some instances, results in deferring the gain or loss on the derivative in other comprehensive income. That is to say, it is retained in under comprehensive income until the forecast transaction arises, and at that point, it is reclassified to profit or loss. However, fair value hedge accounting gives rise to a broadly equal and opposite adjustment to the carrying amount of the hedged item. So, for example, you have a fixed to floating swap, and then you have a fixed rate loan on your books, and you're designating the derivative in a hedge accounting relationship of that hedged item. And what happens there is you're effectively measuring a fair value hedge accounting adjustment against the hedged item on balance sheet to basically true it up from the fixed interest rate that is stipulated in the contract with the borrower and the floating rate that is present in the swap. Now, if the fair value of one, either the hedging instrument or the hedged item, decreases one way, then it is probable that the fair value of the other will increase the other way because there's that economic offset, albeit probably to a lesser extent to before the case was before the start of the outbreak. Before we move on, it is worth remembering that IFRS 9 is a principles-based standard that does not prescribe when a significant increase in credit risk arises, or how forward-looking multiple macroeconomic scenarios are to be determined. This gives rise to the need to apply judgment. And the application of IFRS 9 judgment, in fact, requires lenders to adjust their approach to assessing significant increase in credit risk and estimating expected credit losses when circumstances change. An example of this is because the relationship between macroeconomic variables to expected credit loss parameters may no longer hold or provide intuitive results. And remember, ECL parameters are the exposure at default, the probability of default, and the loss given default, or what we colloquially refer in the banking sphere as the EAD, PD, and LGD. Another thing worth bearing in mind is that 30 and 90 days past due as indicators of significant increase in credit risk and default are rebuttable presumptions, and it may be appropriate to rebut them if evidence supports this. For example, the provision of a payment holiday which is not driven by deterioration in credit risk, may mean that the clock would start for 90 days past due or 30 days past due from the end of the term of that payment holiday. Also, please remember that the primary indicator of a significant increase in credit risk is a relative, unexpected increase in the probability of default over the credit risk exposure's expected life. So what we're saying here is, on day one, upon origination, the lender would forecast at each observation date what it expects the probability of default to be, and then it compares that expected probability of default at the observation date to the actual probability of default. And if there has been either an increase in relative terms or absolute terms, but the standard requires at least relative terms, then there would be a significant increase in credit risk, and that credit risk exposure would move from stage 1 to stage 2. But you are comparing a relative increase as at the observation date. There is information out there, for example, rating agencies are starting to publish this, and undue cost or effort does not mean no cost or effort. The information does need to be reliable and relevant. That is, do not just go to an outlier in terms of availability if there are questions over its reliability. The whole picture needs to be taken into account, and while borrowers are generally worse off with credit risk increasing, governments have introduced various fiscal measures to protect economies. This will inevitably give rise to macroeconomic scenarios, as well as their associated weightings being changed and calibrated over time. For example, more severe downsides may be implemented and weightings skewed towards those downsides in total when compared to the base and upside scenarios. However, it is acknowledged that models cannot be recalibrated that quickly. So it is accepted that a fair amount of all of this is reflected by post-model adjustments and overlays. Post-model adjustments and overlays can be affected to inputs and assumptions, such as GDP, HPI, unemployment, TDI, parameters, with these being the EAD, PD, and LGD, as I said earlier, probability of weights that are applied to the scenarios, for example, 60% to the base case, 20% to the worst case, and 20% to the best case, and the model outputs themselves. For March period end, these post-model adjustments and overlays were mainly affected to probability weights and model outputs, with paper and reverse stress tests being applied in practice. However, there is a question over how much of this is captured in the forecast, and it is expected that they will be applied earlier. And when I say it is expected that they will be applied earlier, I'm referring to the adjustments or the overlays on in the process going forward, given the governance and robustness of the estimated expected credit losses is stronger the earlier the adjustment is effective. This means that models will again become more of value than the post-model adjustments and overlays themselves. And there's a general expectation that this will start to become the case from Q2, June 2020 onwards. Furthermore, these post-model adjustments and overlays will be updated as new information comes to light, and they need to be substantiated. On information, different credit risk exposures are being impacted in different ways. While there are question marks as to whether there is information that can be acted upon in terms of retail and consumer credit portfolios, there are also question marks over the ability to process all of the information that is available when it comes to corporate exposures, given they are provided for typically individually and on a manual basis. So a question mark over there being too little information for retail and consumer credit portfolios, and a question of there being too much information for corporate exposures, given the latter are typically provided on an individual basis, and this is done manually by determining the recoverable amount vis-a-vis the exposure that is on the books at a point in time. One thing that I would like to say is, remember IFRS 9's raison d'etre as issued by the ISB. It is to provide users with insights of where the entity is in terms of the credit cycle, and increased transparency is needed at uncertain times. This will be achieved through adhering to the requirements of paragraphs 122 and 125 of IS1, which is presentation of financial statements. These paragraphs require qualitative and quantitative disclosures around critical accounting judgments and sources of estimation uncertainty, which people colloquially refer to as sensitivity analysis over inputs and outputs. Also, please remember IFRS 7 financial instruments disclosures requirements that relate to credit risk and impairment under IFRS 9. There is also a challenge to ramp up disclosures given resource constraints within an organization, but it is hard to make meaningful comparisons without granular disclosures. And at this point, before we move on to the Dear CEO letter that the PRA issued on the 26th of March, I'll now just take a pause to see if there's any questions on the material that we've covered so far. James.
Yes, Mark. This relates to government assistance, and specifically the question is this an adjustment to the probability of default or the loss given default?
Thank you, James. There has been a fair amount of debate about this, and this may change over time, but some thoughts on this. Firstly, one needs to assess whether the assistance is integral or not integral to the loan asset. If it is integral, then it is captured in the estimation of expected credit losses. If it is not integral, then IAS 37, which is the standard governing provisions, contingent liabilities and contingent assets, applies to the reimbursement asset. An example of a non-integral credit enhancement is the provision of a financial guarantee contract by a third party to the lender. So, in layman's terms, there's a relationship between the lender and the borrower, and the lender goes to another party, a third party, or a related party, and asks them to indemnify it in case that its debtor defaults. However, an integral credit enhancement is factored in at the point in time of granting the loan. If it is an integral credit enhancement, then it is captured in the estimation of expected credit losses, with the current thinking being this generally reduces the loss given default and not the probability of default. And this is because the risk of default associated with the borrower does not decrease in terms of the schemes that we have seen. This is because the borrower still needs to default for the government to participate in the loss. The ISB discussed a similar matter at the Impairment Transition Resource Group in 2016, I believe, whereby the question presented was instances where credit risk exposures are 100% insured, and this, for example, exists in certain territories such as Canada, and it was acknowledged that in such instances, you may have a stage transfer because there may be a significant increase in credit risk, and that means you'd move from stage 1 to stage 2. But because of the credit insurance, in this example, there would be no ECL recognized as the result. However, the entity would need to go through a process in terms of disclosing the fact that this has moved from stage 1 to stage 2. If the risk has increased as a result of credit deterioration, and also disclose why there is no expected credit losses on that balance or group of balances. Okay. Sam Woods, Deputy Governor and CEO of the PRA, wrote to CEOs of banks and lenders on the 26th of March, and this letter is available on the PRA's website. The PRA did this in light of the significant measures taken by governments and central banks to encourage banks in their lending activities and their providing of support. The PRA have stated that these measures are expected to remain in place throughout the period of COVID-19 disruption. This is particularly relevant for March year ends and interim financial reports onwards and going forward, given the fiscal measures commenced before then, and expected credit losses, like most accounting estimates, are estimated on the basis of future cash flows and assumptions about the future that existed as at the reporting date. This letter and annex focus on three key areas: IFRS 9 accounting and the definition of default, covenant breaches by borrowers, and the regulatory capital treatment of IFRS 9. On the point of interim financial reports, I'd just like to give people a heads up. There is early talk of regulators comparing what is reported in 2020 interim financial reports and 2020 annual financial statements. And the reason for this is to see the changes in accounting estimates, such as expected credit losses, over the year. The uncertainty associated with expected credit losses estimates in a COVID-19 world will only unfortunately be higher in the first instance. Forward-looking information that reflects the macroeconomic impact of COVID-19 is limited, and thoughts on the overall impact is changing. For example, in terms of the recession, there has been talk of a sharp V, then more of a U, or a skewed V, with a longer period of recovery. And now we're hearing talks about Ws, whereby there would be a bit of a boost in the economy when the lockdown is eased, but then if there is a second peak, for example, then we may re-enter a bit of a recession. And also stepped Ls or Js, whereby we drop off a fair amount and then we start to recover quite rapidly after that. But this is a very changing area, and it's an area that views are changing quite a bit, but the latest is Ws and stepped Ls and Js. This does present risk to estimating expected credit losses, and sound and reliable assumptions need to be used so as to minimize the chance of materially overestimating or underestimating expected credit losses. In the current climate, models can overpredict defaults. The PRA has therefore intervened, asking for either models to be dampened, judgment processes introduced, or relative and absolute definitions of significance changed. The PRA has stated that two aspects are critical to this, and it is the view that the consideration of these aspects adhere to the requirements of IFRS 9. Firstly, judgments do need to be well balanced. Yes, the data is showing the economic and credit conditions are worsening, but public support needs factoring into the modelling as well. And economic theory also needs to be taken into account. For example, mean reversion kicks in after 5 years. Secondly, lenders are to assess the actions to support borrowers, and these may not necessarily automatically give rise to a stage transfer under IFRS 9 or a default under CRR. And we will now start to pick apart some of these messages. When it comes to data, economic consensus does lag public sector intervention. We would therefore advise to use information that is available for a 31st March year end or quarter end. Use that information that is available on or around the 31st of March, but not the end of April or the middle of May, as the latter may include factors that arose after the 31st of March. The same thought process applies to a 30th June year end or interim end, whereby try and crystallize the information that exists then as quickly as possible, because there may be conditions that relate to Q3 that start to get pushed down into Q2. As I said earlier, there is an acceptance that the expected credit loss impact of COVID-19 in terms of both significant increase in credit risk and expected credit loss estimation itself will be achieved through an overlay. This is because the traditional drivers of credit risk may no longer work as they did. For example, government-enforced forbearance needs to be considered in terms of what was the borrower or whether the borrower or group of borrowers on the edge of stage 1 and stage 2 before COVID-19 or not. So what we're saying here is, look at your borrowers in the portfolios, see how close they were to the cusp of moving to stage 2 or stage 3 before the onset of the outbreak. And if they weren't, but they've now moved from stage 2 to stage 3, then effect an overlay to effectively pull them back. I say this as freezing PDs or stages pre the crisis has been agreed by regulators to most certainly not be compliant with IFRS 9's requirements. I also say this, as it is probably easier not to suppress current triggers, as their operating may have been embedded in your systems. So there is a need to manually pull the credit risk exposures back to stage 1 or stage 2. Some other considerations are, because IFRS 9 requires assessing significant increases in credit risk over the lifetime of the exposure, that shorter term exposures are therefore intuitively going to be impacted to a greater extent than longer term ones, given the duration of a recession. For example, if a recession lasts 2 years and the contractual term of the exposure is 6 months, then that is at risk in terms of recovery for the entire period and more, the entire period of its contractual life and more. This will also manifest in forecasts becoming shorter term, with the long-term trend possibly kicking in earlier. And it goes without saying not to double up on other post-model adjustments or overlays for other political and economic uncertainty. For example, I know that a number of banks and lenders have post-model adjustments for the uncertainty associated with Brexit. The word of advice here is to make sure you're then not doubling up when you're also doing a COVID-19 post-model adjustments as well. Days past due, as I said, is losing its relevance, and while one needs to be more granular, a bottom-up approach may not be feasible. Therefore, there is a need to identify locations and sectors and consider these on a top-down portfolio basis, as certain significant balances or group of balances may be impacted more so than others. As I said, we would advise you not to suppress PDs, given the basis on which they are prepared and the amount of time it takes to recalibrate them. But days past due, or start counting days past due after, for example, a payment holiday. We would also advise you to see relative movement in probabilities of default, with larger jumps therein being investigated more granularly. I say this as these are more likely to be indicative of a credit deterioration as opposed to a lack of short-term liquidity, with credit deteriorations giving rise to significant increase in credit risks and a credit risk exposure being credit impaired, while short-term liquidity does not necessarily do so. A point worth bearing in mind is that gaps do exist in terms of government assistance, and one should consider IFRS 9 as part of borrower eligibility testing so as that this can be modelled in later, as we mentioned earlier in this webinar. Accounting decisions are to be made off the basis of facts and circumstances and schemes, terms and conditions, not newspaper headlines. Moving on to another aspect of the PRA's letter, the PRA specifically spoke about covenants, given the role these play in loan agreements and credit risk management generally. Similar to forbearance, lenders need to determine whether there are normal or COVID-19 induced covenant breaches. Examples of COVID-19 induced covenant breaches are on the screen, being temporary changes in borrowers' reported earnings, suspension of business or other material adverse clauses, and modifications of the audit report attached to audited financial statements. And we spoke about modifications to the audit report earlier in this webinar as well. They also include delays associated with the provision of financial statements, compliance certificates that are required in accordance with the requirements of the loan agreement, and third-party valuation that may also be required in accordance with the provisions of the loan agreement. I like to think of these latter three as being similar to payments not hitting accounts for issues with technological systems, whereby a delay is arising because of COVID-19, whereby the borrower cannot get the information through to the lender, which would not be considered to be indicative of a borrower's inability to meet their repayment obligations. So to go back to my analogy, if the non-payment is rectified within a specified time frame as stipulated within the contract, then it is not considered to be a covenant breach, and the PRA is asking that such delays are also not considered to be covenant breaches, given the circumstances that we live in at the moment. As a result, the PRA, as I said, understandably asked lenders to consider covenant breaches carefully during the outbreak. This is similar to the underlying theme of needing to determine whether the breach or waiver is due to credit deterioration or a lack of short-term liquidity. And this is quite a fundamental point. You need to assess whether what is happening to the borrower is a result of credit deterioration or because of short-term liquidity problems. The PRA is clear in that COVID-19-induced covenant breaches should be waived. The PRA is also clear that when doing so, lenders should not introduce new charges or restrictions on borrowers that are unrelated to the facts and circumstances that led to the breach. Also, modifications to audit reports will become the new normal for a while, and people will get used to them. These modifications could take the form of modified opinions, because auditors cannot discharge all their responsibilities in accordance with the requirements of international standards on auditing or obtain all the evidence that they need. Material uncertainties associated with going concern. And remember, an entity needs to disclose its position vis-a-vis going concern as to whether it's a going concern or not. And then for regulated deposit takers, which are public interest entities, there are specific sections in the audit report that relate to an entity being a going concern. And if it is not a public interest entity, then there may be an emphasis of matter paragraph in the audit report for the entity not being a going concern, or because of uncertainties associated with the entity's ability to continue as a going concern. These modifications to audit reports should not automatically give rise to a default on the CRR or a stage transfer under IFRS 9. On CRR, it is worth remembering that a covenant breach is a possible indicator of unlikeliness to pay, but does not automatically trigger default per se. The thought process that I have just outlined extends to other COVID-19-induced breaches and waivers of covenants. A few quick words on the regulatory capital treatment of IFRS 9. Transitional arrangements are in place whereby the regulatory capital impact of expected credit losses is being phased in over time, and firms can currently add back 70% of IFRS 9 expected credit losses in 2020. This is only the case if the firm opted into these transitional arrangements in 2017, which the PRA encouraged at the time, and these cannot be opted back into now. If a firm avails of the transitional arrangements, then all aspects of supervision of firms is performed under the transitional basis and not the fully loaded figures. This includes the determining of capital resource requirements. And I understand and appreciate that I've been talking for a while now, so I'll just take a short pause to see if there's any questions.
Yeah, thanks, Mark. A question regarding the arrangements that you spoke about. We've heard that the transitional arrangements for IFRS 9 ECL under CRR may be amended. Is there any truth in this?
I've heard this too, in the sense that the 70% may be increased back to 100%. However, this does need to be approved at an EU level, given we are still in the transition period of the UK's withdrawal from the EU. Also, the EU, as of last week, is putting forward a number of other exceptional temporary measures to alleviate the immediate impact of COVID-19 related developments. And these include treating public guarantees that are granted during the crisis more favourably, postponing the date of application of the leverage ratio buffer, and modifying the way of excluding certain exposures from the calculation of the leverage ratio. There are also plans in terms of the treatment of non-performing loan prudential backstop. I mean, so there is something in the works. The Basel Committee was talking about it about a month ago, but you need to understand and appreciate, James and all those on this webinar, that we're still subject to EU banking regulation until we fully exit the EU, and therefore we need to wait for the EU to process changes before we can adopt them in the UK. And my understanding is that the UK is supportive of these measures, and the EU, the Commission, the Parliament and the Council are trying to get these through as quickly as possible to provide temporary relief to banks given the crisis, and also because of the role that banks play in economies. Okay, this slide summarizes some of the key considerations that we have talked through. Clearly, thought needs to be given to the incorporation of forward-looking information, macroeconomic variables, multiple scenarios and probability weightings for the reasons that I've outlined in this presentation. Definitions of what constitutes significant increase in credit risk and default need some consideration as well. with definitions being amended as a result, as we have seen. Focus now is becoming more on default definitions than significant increase in credit risk the longer a recession lasts. And the combination of the first 2 points, that is to say, economic scenarios and forward-looking information, and application of significant increase in credit risk and default definitions, will give rise to the increased use of post-model adjustments and overlays, which still need to be substantiated and justified. Stakeholders will also start to benchmark these post-model adjustments and overlays. In practice, repossessions will be suspended given the property market has come to a standstill, and there will be difficulty in obtaining uncaveated new collateral valuations to estimate loss given defaults. Also, the likelihood of guarantees, financial guarantee contracts being called as heightened, with expected credit losses thereon coming more into play. And lenders and borrowers will modify the terms of their loans, which will have measurement implications generally, but expected credit loss implications as well. Governance processes are fundamental to all of this in terms of underpinning how well IFRS 9 is applied during the outbreak. This slide also summarizes some of the key considerations in a bit more detail, with governance starting this list. A few points here. IFRS 9 needs to reflect what you do in practice and change accordingly when you change how credit risk is managed within your institution, with this including consideration of changed exit strategies. High impact, low probability scenarios are to be captured, as is the case with any source of uncertainty. The conditions of schemes and changes thereto need to be understood and reflected in IFRS 9 as quickly as possible as part of changed credit risk management practices. Borrowers are to be treated fairly, with there being an overall need to ensure that circumstances are reflected in the right way rather than have unintended consequences when we come out of this. And finally, please remember to be transparent in disclosures to the market, particularly when it comes to critical accounting judgments and sources of estimation uncertainty in quantitative and qualitative terms. And by applying changed credit risk management practices and judgment under IFRS 9 as a requirement of the standard. So please bear that in mind as well. BDO UK and globally has resources on its website on both the application of IFRS 9 and COVID-19. And there are Ariel, a partner in our banking and alternative finance practice, who has close ties with the Association of Foreign Banks, and I'm sure known to a number of its members, and my contact details are on the screen as well. Should you want to discuss anything IFRS 9 related, or anything we have covered today, or any accounting and financial reporting matter further. May I also take this opportunity to remind you that the slides and a recording of this webinar will also be made available, so you'll have Ariel and my contact details in the pack. And on that note, I thank you very much for your kind attention. I hope that you found this webinar useful and that you continue to keep safe and stay well. We will now take a few more questions. James?
Thank you, Mark. So as Mark said, now we've got to the end of the actual presentation, please feel free to ask any questions that you'd like to by using the box, as we've explained. In the meantime, Mark, there is a question which is regarding payment holidays. So could you expand on payment holidays, example for mortgages, and how customers' PDs and LGDs can be updated when the bank doesn't have meaningful info to input into the IFRS 9 model?
Well, I think the first thing that comes to mind is when you're giving a payment holiday, assessing why the payment holiday is being granted. If it's because of general government measures, and if it's because of the borrower facing short-term liquidity issues, then the advice that I would give personally, and I know that this is supported in practice, is not to update the PDs. So leave the PDs as they are. Do not suppress them. Let the credits flow through the process normally. So that means you'd have a movement from stage 1 to stage 2, and then consider the payment holidays themselves and why the borrowers are requesting them. And I mean, you can do this on a portfolio basis for retail and consumer, and IFRS 9 does allow you to not necessarily attribute to individual credits in the portfolio, those that move from stage 1 to stage 2, but say a portion of, and support that by economics testing and theory, a portion has moved to stage 2. So you'd have a portion, you'd know that a portion of the credits have moved from stage 1 to stage 2 as a result of those payment holidays. The majority have not. You do not need to then individually attribute the implications of that to the individual credits, but it is very much considering, in that scenario, James, and the member who asked the question, the segmentation of your portfolios. So the more segmented are, the more closely related the credit risk exposures are, the easier this will be to do in practice. But what we're seeing is that banks are not suppressing their probabilities of default or changing them because of the amount of time it takes to do that. However, they are then pulling back credits from stage 2 to stage 1 or stage 3 to stage 2 if it's not indicative of credit risk deterioration but short-term liquidity issues. In terms of the loss given default, I mean, the payment holidays itself, that would impact the exposure at default because the amount on balance sheet is larger than it was expected to be. We've spoken about the probability of default, but if we think about the loss given default, that's 1 minus the recovery rate. And the recovery rate is either repossessing the collateral and selling it, and in a number of instances, that market has stopped because houses are not being sold, for example. Another alternative is to sell loans to a willing buyer, and another scenario is putting it into workout. And that means that you'd need to look at how much you're expecting to recover. So if there's a payment holiday, and it's just, say, for example, extending the cash flows out by 90 days, then you would discount that back to present value, and you would have the gain or loss being recognized because that is a modification in P&L, but you've already accounted for that if it's not indicative of an increase in credit risk or default.
Thanks, Mark. Okay, so it does appear as if I hope we've covered everybody's questions for today. So I guess I'd like to wrap up our session now. I'd like to thank everybody for taking the time to attend. I'd like to thank Mark and also the whole team at BDO have helped put this together. There's quite a lot that goes on behind the scenes organising the webinars, so I'd like to thank all of you for that. And finally, on behalf of the AFB,